Recently, there has been a lot of discussion regarding the commodities market and cryptocurrency colliding, as well as whether the current situation is only a retreat or the beginning of something far more significant. We're going to differentiate fact from fiction in this video, and you'll leave feeling much more knowledgeable and assured about what you're seeing on your screen. In New York, it is Friday, February 13th. Please let us know what day and time you're watching from in the comments section before we continue. In case you haven't seen the chatter I'm referring to, it's the same type of post over and over again. Just a short note. If you appreciate this kind of straightforward, drama-free dissection, please support it by subscribing and commenting on our future Ledger Anna. Silver simply plummeted. Gold broke. Bitcoin plummeted to the bottom. Volatility blew up. The icing on the cake. Reports that states are preparing to manufacture their own metal currency and that Fort Knox is deserted. That's quite a bit. And it feels like the universe is turning upside down in real time when you combine that many allegations. Here's the issue, though. Your brain interprets a headline that contains 5 distinct stories as a single narrative, explanation, and conclusion. And that's how people get scared and start acting inappropriately. Thus, let's proceed as usual. Together, we slow it down. We separate the strands as we observe what is truly taking place. Because it's true that prices fluctuated a lot. That much is certain. Silver quickly dropped below the high 7s level, according to latest market data. Additionally, gold fell below a significant round number that traders frequently discuss. The same is true of Bitcoin. After functioning as a floor for weeks, it collapsed through a level. The move was real then. However, the move's significance is that people begin freelancing there. The first major freelance assertion is that there must be some covert panic. Perhaps something broke, or it can be the most dull financial explanation. Liquidity thinned, leverage flushed, and the door shrank as everyone attempted to leave through the same entrance. And I'm not being cute when I say that. I mean it literally. If you have ever been to an airport, you are aware of what occurs when a flight is canceled and one gate is suddenly used for 3 flights. The line does not just lengthen, the entire system becomes strange. Humans are unable to hear. People begin to speculate. "The plane left," someone shouts. Then, rather than the facts, everyone responds to the ranting. In a market, that is the sensation of thin liquidity. This is when the cunning comes in. The chart may appear to be telling you a story about the economy when liquidity is low, but it may instead be telling you a story about order flow. Consider it this way. You can haggle if there are 10 apple vendors at a farmer's market. Prices remain quite constant. However, the price of apples may fluctuate significantly if 9 of those vendors leave early and there is only 1 table remaining, not because apples became scarce on Earth, but rather because the market shrank. Because of this, a sudden dump does not always indicate a shift in the fundamentals. It could indicate that the market become momentarily thin. The following misunderstanding results from that. A large crimson candle is thought to represent everyone sold. Not always. Sometimes the price must go further to find a buyer, since only a few forced sellers are hitting a thin book. In a moment, I will demonstrate the one indicator I use to distinguish between a transient flush and a true trend shift. However, we must first address the discourse surrounding silver. Silver differs from other metals. It is a hybrid of an industrial input and a financial hedge. It can therefore trade like a risk asset when anxiety strikes. It can function as a hedge when inflation strikes. It may trade like a commodity when there is a surge in demand for production. Additionally, the dollar may trade like an item being valued using a more powerful measuring stick if it surges upward for a week. Therefore, you will continue to have whiplash if you attempt to explain every move using the same explanation: manipulation, shorts, central banks, or retail demand. All of them may have been combined in the action we just witnessed. And it's okay if it doesn't sound satisfactory. In most cases, reality is. Let's now discuss the signal I mentioned. It isn't some covert sign. The spread is the problem. One thing is evident when the actual market offers you the same metal at around the same premium right away after the paper price drops. However, it tells you something else when the paper price drops and physical premiums either increase or remain unyielding. It indicates that the supply chain is not operating as the chart indicates. And that's just what has been going on in certain areas of the market, according to recent market commentary. Paper prices were fluctuating sharply, although pricing and physical availability seemed to be attempting to stabilize. It's a hint, but it's not a guarantee of anything. A hint that the relocation might be less about physical overflow and more about paper placement. For this reason, You don't just stare at the area when purchasing real goods. You keep an eye on shipment schedules, inventories, and the bid amount that dealers are truly prepared to print. I want to clarify one more issue, so let's return to volatility for a moment. The VIX is only in the low 20s according to many. It's nothing. When it reaches a crisis level, wake me up. Although it's a catchphrase, it's also a trap. Because volatility cannot be turned on or off. It's a system. Furthermore, speed is more significant than level. Even if a fear gauge isn't at historic extremes, it might nonetheless cause compelled behavior across portfolios if it shifts rapidly from calm to tense. Risk models may be triggered by it. Hedging may be triggered by it. It may cause sell what you can situations. And even if the news is about stocks, such moments might affect Bitcoin and silver. Therefore, the question is not whether the VIX is at a magical figure. Is the leash being tightened by risk managers? You can sense it everywhere if they are. Speaking of all places, let's talk about those few trillion lines you've undoubtedly heard. Market value can quickly disappear when large asset classes see a coordinated sell-off. The marginal price changed, which is psychologically significant because individuals feel impoverished and respond defensive, which might temporarily become self-fulfilling rather than because all the riches literally vanished. However, here is also where the skeptic's opinion counts. Much of the most blaring comments at the moment is intended to force you to adopt a binary perspective. Either sell everything since the bubble burst, or buy everything because the system is coming to an end. Most consumers purchase one of the two emotional items that are being marketed to them. Here is my counterargument. A market may experience a powerful flush while still being on a longer-term bull trend. Additionally, a market may have a strong rebound while still being in a longer-term topping process. Both may be accurate. You don't anchor on a single day for this reason. Your process is your anchor. The second major assertion now relates to volatility. The level of volatility is soaring. All right? Yes, occasionally. One of the most frequent errors I see is people confusing different thermometers and expressing shocked when the readings don't match, so you have to be careful about what volatility we're even discussing. During the shakeout, the VIX, a volatility indicator linked to broad stocks, did rise into the low 20s. However, the implied volatility of metals and the volatility of cryptocurrency are distinct and can occasionally move in opposite directions. Because traders have previously paid for protection and are now unwinding it, you can have the broad market fear gauge rising while the anticipated move in a particular commodity is actually narrowing. In other words, since you boarded the windows yesterday, you can have a storm outside while the weather inside your home is cooling down. This explains why you saw individuals debating online, with one person claiming that volatility was exploding and another claiming that it was actually declining. Both of those could be correct. All they are doing is examining several dashboards. Since most people ignore this section, this is when things start to become interesting. There are situations when the physical price and the paper price operate differently. They do occasionally. However, they become silent like cousins when the market is erratic. Spreads quickly grew, and premiums in certain areas remained sticky even as the paper price fluctuated, according to publicly released dealer notes and pricing sheets. If you have never gone through that, it can be mentally taxing since you may be looking at a screen that says down, but when you call a dealer, the quote doesn't feel depressing at all. Wait, is it cheaper to sell than to buy? Is a question that many ask, and for some things it can feel that way at certain periods. This isn't because the metal turned magical, but rather because the ask and bid are dancing in a tense market. Allow me to explain in simple terms. In times of increased volatility, market makers take precautions. Dealers defend themselves. The lane widens for everyone. Your sell quote is therefore determined by their ability to hedge, the amount of inventory they can replace, and the speed at which they believe prices could go in the opposite direction. The same thing is the basis for your buy quote. Together with the risk of shipping and restocking and the reality that people don't care about location if they are in a panic. Do you have what the crowd wants? Because of this, a buy price may appear costly and a sale price may appear harsh all at once. It is not evidence that demand is limitless or that demand is fictitious. It is evidence of the market's anxiety. Additionally, take note of how the rumor always comes in the same emotional package. Since extreme versions spread more widely, it's always the most severe version rather than, hey, there might be accounting questions. However, because here is where the discussion frequently becomes sloppy, let's discuss what a real audit would truly entail. A politician going into a vault for a picture is not an audit. An actual audit is a tedious, laborious procedure, weighing, assaying, cataloging bars, confirming serial numbers, balancing records, and revealing what is and is not burdened. People's imaginations run wild when it comes to the final section: encumbrances, pledges, swaps, leases, all the things that complicate the story. Could there be odd arrangements about reserves now? Governments undertake complex things, to be sure, but complex does not mean lost. Here's why I'm making this argument. You will always be in emergency mode if you base your decisions on the most extreme rumors. Additionally, emergency mode results in careless decisions. Dull answers are actionable, thus, if you are interested in this topic, you should really desire the dull answer, whatever it may be. I also want to draw attention to a historical fact that is sometimes overlooked. Although officials have publicly stated reserves and governments have conducted partial verifications and inspections at various points in time, detractors contend that these actions were insufficiently thorough or independent. This subtlety is important since emptiness can still be false, although critics find it to be true. Alright, remember that detail as we proceed, because the next rumor operates similarly. It transforms a nugget of truth into a trailer for a motion picture. The third major assertion is the one that stirs up strong feelings in people. There is no gold in Fort Knox. Let's take our time with this. There is a distinction between there is zero gold and there hasn't been a contemporary, thorough, independent audit, as some people would like. The sentences are not interchangeable. And the first part is what's actual at the moment. Congress has once again called for greater openness and a more thorough auditing system. You can infer anything significant from that alone. This is a psychologically potent and politically useful topic. However, it doesn't prove to be the most extreme rumor on its own. This is the question I want you to honestly answer in the comments section. Is there all the truth, none at all, or something in between in your opinion? Since reality typically resides in that middle choice, no one likes to discuss it. Another article went unnoticed while everyone was focusing on that rumor. At least within their own borders, states are looking for methods to treat gold and silver like money once more. I'm not referring to a movie plot, either. Texas has previously enacted laws recognizing gold and silver as payment methods and gradually developing a system linked to its bullion depository. This isn't simply one state speaking aloud, to be clear. Bills and initiatives that attempt to classify gold and silver as money for certain purposes have been slowly circulating through several states over the past few years. Depository systems, tax treatment, payments, and even investigating digital rails that stand in for metal that is being held in custody. The majority of these endeavors are modest. Whether you like it or not, the direction is important because it shows that trust is being negotiated in public. Some are operational, while others are symbolic. And trust is the most important term. People don't consider other options when they have faith in the currency. They begin searching for off-ramps once they lose faith in the currency. Bitcoin is sometimes that off-ramp. It can occasionally be gold. Sometimes it's as easy as transferring funds to shorter-term securities. Sometimes people would prefer hold things than currency, so they just purchase more inventory for their company. And the type of day we just witnessed occurs when a sufficient number of people look for off-ramps simultaneously. Here is yet another detail that is often overlooked. You still have a practical question, even if a state establishes a framework. Which unit are you really using? A receipt, a digital credit, a bar, or a coin? Because custody and counterparty risk are reintroduced the instant a receipt is established. Thus, metal money seems like a straightforward concept. However, the implementation is disorganized. I don't consider these headlines to be over because of this. I handle them as though the system is testing. Volatility is also produced via experiments. People react before the system stabilizes, not because they are bad. That does not imply that you will use gold coins to pay for groceries tomorrow. However, it does indicate that the discussion is shifting from online forums to actual policy. Furthermore, policy is important since it modifies incentives. This brings us to the second remark question. Would you like to maintain everything in dollars, or would you use the opt-in mechanism your state offered to settle some payments with metal-backed credits? Since the market move remains at the center of this, let's zoom out once again. Bitcoin, gold, and silver all saw significant declines, and people are acting as though this indicates that everything is broken. Correlation during a rapid sell-off, however, does not prove a single conspiracy. Sometimes it's just the same group of people relaxing simultaneously. To put it another way, when the same funds and institutions own a variety of assets and receive a margin call, they sell what they can sell rather than what they wish to sell. The strange aspect is that risky assets and safe assets decline simultaneously. It's not a declaration of philosophy. The issue is with the plumbing. I actually agree with one of the points made by the guest expert I listened to. The best work is done by disciplined people in pullbacks. However, I want to express it my way because people lose their minds when the internet turns that into a catchphrase. Buying every downturn is not the aim. Creating a plan that endures dips is the aim. Furthermore, neither hero trades nor sophisticated charts are the most straightforward strategy for the average person. It's patience, time, and position sizing. A pullback is not an emergency if you're long-term stacking physical metal. Yes, there is a sale, but only if you had previously planned to purchase. It's just noise if you didn't intend to purchase. This is where you might be surprised. In fact, volatility may decrease following a violent move because the market can relax after a significant portion of leverage holdings are eliminated. Because of this, the chart displays a large candle, and a few days later, the anticipated move bands begin to tighten. It's similar to popping the tab and shaking a Coke can before the fizz subsides. Though it didn't endure forever, the chaos was real. Does that imply that silver will stop dropping now? No. And this is where I will challenge a widely held belief. People enjoy pointing out certain goals as if they can predict your destiny. As if the market owes them a map, they will insist that it must go to this figure. You owe nothing to the market. Ranges is a more truthful way to look at things. For a long time, silver has been living in a wide spectrum. Additionally, the market is essentially a rubber band when you're in a range. Toward the edges, it snaps. It frightens individuals before retaliating. Additionally, every time a range extends, it feels like the end of the world if you have never traded ranges before. I therefore want you to think in zones rather than fixating on a single magic price. Where were the buyers the last time? Where was there a gap in the market? What caused the momentum to change? Zones are what they are, not certainties. Now, two entirely different types of people will be watching if we do manage to get another leg down. A short-term bounce is what traders want, and accumulation is what long-term buyers want. Furthermore, those two individuals shouldn't be following the same strategy. The upcoming week is important to a trader. The following 10 years are important to a long-term buyer. For those who are long-term purchasers, this is the discipline. It's not your goal to nail the bottom. You scale, you make a small purchase, you hold off, you make a small purchase, you hold off. Additionally, you only get bigger when the market confirms it, not when your emotions compel you to. Right now, I'm aware that someone is asking, okay, but what about my retirement account? Do I even own what I think I own? This is where things get a little heated, but I'll keep it civil. Buried within the hot takes is a valid point. Custody is important. You run the risk of counterparty risk when you hold an asset through an intermediary. It's true. However, there is a trap as well. People assume you own nothing when they hear the term counterparty risk. That isn't always the case. Depending on what you're keeping and where it's held, different legal frameworks, account structures, segregation regulations, and protections apply. In all honesty, most individuals are unaware of the difference between having strong rights and having weaker ones. And that's the true issue. Not all people are doomed. The issue is that most individuals don't pay attention to the fine print until it becomes important. I want you to do something, and you can do it after seeing the movie. Bring up your statement. Keep an eye out for the terms separated, beneficial owner, and custodian. You have homework if you don't understand what those signify. Because part of being an adult investor is knowing custody, whether you purchase real gold or not. The government shutdown rumors are another element that people are adding to the mix. So let's talk about them now. The current problem is not that the government as a whole vanishes. A budget deadline linked to the Department of Homeland Security and a Senate vote that failed to clear the hurdle are the immediate problems, increasing the likelihood of a lapse beginning on Saturday, February 14th. That bit is real then. The calendar shows it. The headlines mention it. However, the market impact is not always present. Shutdown drama can occasionally be priced in. It isn't always. Because it piles on top of everything else that individuals are already worried about, it can occasionally become a larger confidence story. And that leads us to the part about uncertainty. Because the overarching theme of this entire situation is uncertainty, which transcends prices, rumors, and shutdowns. And that is something we can measure. The frequency with which the term uncertainty appears in policy and economic reports around the world is monitored by public indices. Additionally, those indexes have remained high in comparison to the years of calm preceding the pandemic. That gives you some information about the environment, but it doesn't tell you where silver will go in the future. Narratives outpace facts in a setting with a high degree of uncertainty. Because markets are price machines, those who hop from headline to headline annoy them. Instead of thousands of people from many nations, languages, and religious views working together without ever meeting because the price system organizes them, they want probability. Additionally, the price system fosters collaboration when it is let to function. However, when the price system is distorted by regulations, poor incentives, or unclear policy, friction, shortages, illicit markets, and mistrust result. And there's a reason I'm bringing that up. It clarifies why there may be differences between paper and physical markets. The paper market may overshoot when speed and leverage are its governing factors. The physical market may lag when transportation and inventory take center stage. People either panic or educate themselves in the space between them. So, how do you handle all of this? First, you don't fall for a dramatic identity just because you had a dramatic day. Being a genius doesn't happen overnight. You don't become a victim in a single day. Second, you choose the game you want to play. Trading requires risk controls that take the possibility of error into account. A long-term investment strategy must take price fluctuations into account. Additionally, you should shop around if you're stacking physical metal because premiums can fluctuate more quickly than spot. The notion that the greatest moment to purchase is when it drops is something else I want to discuss now. Though incomplete, that is occasionally true. Since a drop without a plan is just a drop, it would be more accurate to say that the best time to buy is when your plan instructs you to do so. An opportunity is a drop with a plan. The retention kicker comes next. The majority of people do not blow up because they are misguided. Because they are mistaken about size, they blow up. At the wrong time, they get too big. They are so excited that they purchase the top. Fear makes them sell the bottom. They refer to it as strategy. Therefore, if you want to be the one who makes it through this and wins in the long run, you should concentrate on behavior rather than forecasts, quick fixes, repeatable actions, or long-term goals. I want to take a moment now to address those who are already doing it correctly. Because no one sees it, if you're successful, share your story in the comments to keep others inspired. People don't see the habits, they only see the results. I know someone will ask, okay, but what if Fort Knox really is empty? If that dire situation were to occur, you wouldn't want to be making snap decisions based on a tweet or a screenshot. So let's take a moment to return to the rumors. Documentation is what you would want. Process is what you would want. Verification is what you would want. Additionally, the pressure is evident from the fact that lawmakers are promoting audit proposals. However, it also indicates that the system operates slowly. Therefore, your plan isn't a plan if it relies on an unexpected overnight discovery. It's a ticket to the lottery. Additionally, although lottery tickets are entertaining, they are not a retirement plan. Let me return to silver now, since that's what brought us all here. Similar sell-offs have previously occurred in other markets. They can occasionally develop into longer bear phases. They can occasionally turn into the precise shakeout that raises the next leg. The chart pattern is not the difference. The macro backdrop makes a difference. Additionally, the macro backdrop is currently a tug of war. On the one hand, there are high debt loads, sticky costs, and political dysfunction that raises risk. You have cycles on the other side. Your reversion is mean. Changes in policy have the power to quickly change public opinion. You will therefore be let down if you are hoping for a single, clean story. This story is a mess. However, messy does not equate to uninvestable. Messy simply indicates the need for rules. These are mine, and if you'd like, you can borrow them. First of all, never make a major choice on a significant day. Second, buy in pieces if you're making a purchase. 3. Always be aware of the reasons behind your possessions. 4th, don't mistake online certainty for actual certainty. I'll give you one more thing now. It was not a random increase in market chaos. The reasons are structural. There is more automated trading than ever before. After concentrating, the liquidity vanishes. Moves can be amplified by options flows. Additionally, the unwind is violent when a popular trade becomes crowded. There is no conspiracy there. That is the structure of a modern market. Therefore, don't assume that the world ended the next time you see a chart that appears to have fallen down an elevator shaft. Let's say the plumbing experienced stress. You will either prepare or panic depending on how you respond to the question, is the underlying story actually changing, or is the market just clearing out the weak hands? Additionally, subscribe, pay attention, and keep your eyes open if you want to continue getting ready with me. Please hit like if you would like this to reach those who are in need of some peace today. See you in the upcoming video. As usual, this is solely for amusement and education. I'm not telling you what to buy or sell, I'm just sharing my market analysis. Before making any financial decisions, consult a qualified expert who is aware of your circumstances.